Namaskar. Hello and welcome to PGurus channel. I'm your host Sri Iyer. This is DGI 397 as we look at the markets for the last week and as well as how recession is going to be affecting our lives perhaps, or also how the GDP of various countries looks like in the next few years. This is a very important section that we'll be dealing with today. So do tune in and stay till the end of this program. Please like this video and also click on the bell button for notifications, and also viewers, this is an important topic, and so I would request you to stay till the very end. So let's welcome our co-host of the day, 𝙒𝙬𝙤𝙦𝙤. Sridharji, namaskar and welcome to PGurus channel.
Namaskar. Good morning to everybody on this bright Sunday, and for a surprise, good evening to folks in United States.
Thank you, sir. And US Fed, have they finally reached the limit, pushed the limit? Have they gone beyond what they needed to go? Your thoughts, sir? Because I think now the recession signals are becoming very, very clear. If you look at the numbers this week, you will see what we are talking about. Sridharji, why do you think Jerome Powell is doing what he's doing? Can you please put yourself in his shoes and kind of walk us through what his reasoning is?
Well, I think, it's a great question, and it's something that is puzzling the markets. And markets are at dichotomy to Jerome Powell. I think Jerome Powell has, if people have not listened, outlined three key things. And the three key things that he has outlined, and of which the number one that he is looking at is employment, labor market. And labor market, if you recall, was his key premise going into the Jackson Hole summit in 2022,
yeah.
Which is I'm looking at the labor market. So he wants labor market, surprise, surprise, they want unemployment rather than employment. The United States is enjoying a very high employment rate, a very low unemployment rate. It has toggled on the lowest 3.2 and the highest is around 4.1. They're trying at 5 to 6% unemployment rate. They believe that's the only way they can bring this inflation down, which we all in the markets don't agree with. And you know that the inflation is not as a result of employment or wage increase. That inflation is as a result of pricing driven by supply chain issues. This is not something that he has come to grips with. On the inflation side, we have reported even in DGI, the inflation is coming down, but the Fed and their counterparts in Europe are not satisfied. They believe it could go haywire. So the only thing that they know that they're doing is keeping on jacking up the rates. Now, relative to the last time that we talked about, what has changed? Very important but subtle but very important point. Right through 2023, they are going to keep the rates high as possible, okay, with the hope that will force the industry to lay off more people and also less borrowing in the market. So when you have more unemployment and we have less borrowing and economic contraction, what does that mean, Sriji? That means in recession, okay? So this is what, unfortunately, Jerome Powell has outlined his strategy to be. And he see things, if you ask me, I think if I'm Jerome Powell, somehow this monetary tinkering will help me to contain the inflation. So I'm prepared to go from 2023 into 2024 to keeping the rates sustainably high with the hope that I can contain inflation even at the cost of growth. And this is what changed the dynamics in terms of the markets.
Thank you, sir, and a very comprehensive explanation. So there are, big different viewpoints to how someone looks at the markets, and United States, of course, is driven by markets more than anything else, especially housing, and housing starts have actually slowed down. House sales have slowed down. When housing sales slow down, then what happens is the overall market starts feeling that pinch because people don't buy new things for their new home. Even if they get into a used home, every family wants to have their own vision of how their home should look like. So that is a fair amount of expenditure that takes place. So I don't know why they are doing this. At the same time, I can understand that these probably are the only tools they have. There are a couple of questions, and one question that I would like you to perhaps take right now, Sridharji, because that way, it's on this topic. Dictator 12321, that's not his name. He wants to know, is Fed trying to reduce the balance sheet?
No, not yet. Fed is on a structured program to reduce the balance sheet, which they have been on. They've been reducing somewhere close to $50 billion a month on their the liquidity in the market. So clearly that is well under the way. But it is not the issue of the Fed's balance sheet. It's basically there is no fiscal policy. What we have left in the market is only monetary policy. There is no fiscal policy. For example, let me give you a very simple explanation. California and New York are in the middle of what they call a task force, which is looking at a reparation bill with regard to the slavery. They want to pay each person somewhere $350,000. This will cost the government somewhere between $100 to $150 billion, the money that they don't have already in their balance sheets. So what you're doing is there is no fiscal on the government side in terms of the stability measures that one requires. So all we have is this interest rate. So which is around, keep increasing the rate with the intent that the corporates would bring down the employment, which will push the unemployment up. There's no liquidity in the market because you put more liquidity in the market when you believe that there is supply shortage on the money supply side. There's no issue on the money supply side. The issue is really around the supply side of the economics, and usually Fed deals on the demand side. Long-winded answer, but to give you a straight answer, they have already started reducing the balance sheet. We probably will give you the numbers maybe in the next market summary as to how Fed has reduced the balance sheet right through 2022.
And Neeraj, and a couple of other questions, I think we're going to answer all these things at the end when we look at the GDP projections for the next few years. That will give you all the answers you're looking for. So let's move on to the next topic. Sridharji, the next topic is looking at the market itself. So can we have the markets, please? So
yes, it's called the red letter day.
Yes, Take it away, sir. Take it away, sir.
Yeah, the red letter day in the world. So all markets red. Thanks to Fed's Jerome Powell's announcement, I'm going to keep the interest rates high all through 2023 at this stage, pivot in 2024 possibly. So what you have, globally the markets react, which is to say that it is going to hurt the companies and the companies' earnings. Probably recession is imminent, at least in two markets, European markets and the North American market. The recession is imminent. We will cover this in the GDP section. But that is why you have high correlation between the Western markets. Of course, Europe is rigged with problems around the Russian war and the oil supply. So therefore, that is. The Asian markets will do better than rest of the markets, but they also caught on to the pandemic and the markets were down on Friday. These are Friday close numbers.
Now let's take a look at the bond market. Go ahead, sir.
Yes. The bond markets, again, you can see the European and the Japanese, they went down. This is the 10-year went down, clearly recognizing that the rate increases are short-term and long-term unsustainable. The US shows a green. It's only because it went up from 3.4 to 3.488. But US has got this 10-year rate has come down from 4%, which we have covered repeatedly in the in the market summary section. But the short-term rates, which is the 2-year and 3-year rates, including 6 months rates, are all pointing to the almost close to the 5% band, 4.5% plus band, indicating that we have a problem. This is another theory, which is we are in an inverted rate market, which means that we are almost ready to launch ourselves into recession.
I think there is a drawing associated with this. Could we look it up? Anyway, well, we'll continue with um, the rest of the news. I'm just going to put the
Oil
yeah. Thank
market.
you. Yeah, oil market. Sir, oil has fallen by at least $2, and Brent is also again following WTI. Is this a demand collapse, sir?
Yes, it is, Sriji. It is demand collapse. When you have recession, people are going to tighten, and more noticeably, very much China. Okay, China's growth is going to be sub 4%, or somewhere close to 4%. So, and there's no sign of recovery from the COVID and all the other adversarial actions that is happening in the Chinese market. So, very clearly that China is one of the big consumers. Obviously, US economy will contract. We don't have supply either, and we have Keystone pipeline leakages or the pipe burst. So, in a summary, what we are seeing is there is an imminent collapse of the demand, especially around the energy side of the business, right across the ecosystem, not just purely the consumer side, but also on the industrial side.
And now let's take a look at currencies. In currencies, looks like except the Asian currencies, the rest are appreciating towards against the dollar. That means there is a flight away from the US dollar. Am I reading it right, Sridharji?
You are correct. You are reading it right. This is it's a red letter day for the currencies as well, but in a positive context. It is right. All the other currencies are moving up. Just to give a simple example, if you take a look at the US dollar to Japanese yen, a US dollar used to fetch almost close to $150, and the Japanese Central Bank of Japan intervened to bring the rates down because they are an exporter. Look at the rate now, 136. Let's take a look at the Chinese renminbi. This was around 7.2, not too long ago, a couple of months ago. When you go back and look at the market summary, it has come down to 6.97. That means they're all appreciating. And then you have the euro to US dollar. It's not 99 cents anymore. It's 1.05. So 1 euro will fetch you 1.05 rather than 99 cents. Similarly, the British pound, which was also toiling and at 1.1, now 1 British pound will get you 1.214. Not too long ago, it was 1.3. So therefore, it's a red letter day for all other currencies. And everybody loves US dollar taking a ding. And so those who think that US dollar should take a ding, they all should be happy.
Sridharji, I have a question regarding the renminbi. Let's go back to the currencies, please. Thank you. So I have a question regarding renminbi. Somebody knowledgeable with the China Bank of China, that's the equivalent of the Fed in China, he said that every note is printed 6 times, meaning like every note has 6 there are 6 notes with the same serial number. That's the easiest way to explain it. So when you say the renminbi is 7 RMBs to a dollar, sir, I'm reading it as 42 renminbis to a dollar. Am I reading it wrong?
Sir, you are an expert on money printing and demonetization and so on, G. 2,000 rupee notes, etc. So I think the Chinese have their friendly cousins from probably India, G. So therefore, if they are replicating, that you have the intellect. The only one thing that I can say about China is no data is accurate. Every data is manufactured. Doesn't matter whether it is economic parameters or currency parameters or currency manipulation that takes place in the market. That is why it is not freely floated. So, I mean, only Emperor Xi Jinping knows what he wants to do and what it is. How soon, how fast, whenever they open up, the true numbers will come out, and the economic catastrophe that is called as the economic management will become very visible. The only reason they have survived is everybody put money in and everybody buys from them. That is the only reason why China has sustained, and a lot of affluent Chinese put money into the Chinese economy, and that is why they have a big reserve. But fundamentally, everything is flawed, including 6 currencies with the same note being distributed, Sriji, as you kind of revealed to the world.
Yes, sir. And just another interesting note here. I mean, I'm not poking fun. This is just the way that GDP is calculated. Let's say that there are two side by side flats. Okay, person, family A, family B. Okay, wife of family A, if she goes and cooks in B's residence, the money that she gets from that is counted towards the GDP. Likewise, if B comes and cooks in A, that also gets counted as GDP. So in a way, you can make up the GDP, in a concerted way, because what China is rumored to have done is somebody told them, if you keep running these bullet trains from place A to place B, it doesn't matter how many passengers are traveling in that counts towards the GDP. So you had empty GDP, empty planes, trains running back and forth, sir. And then when people started pointing this out, 𝙒𝙧𝙤𝙪𝙥𝙥, who's no longer going to be the premier once March comes along, he said, stop counting all these things. Look at how many containers are leaving China, and that should be the way that you should be calculating GDP. That is only for export. See, import thing is still a big mystery. And see what I'm saying, sir. I'm not an economist. I'm not a banker. I have not studied, economies and things like that. But all I see is what I see doesn't smell right. I'm deliberately saying sight and smell. You understand what I'm saying?
Of course, Shriji. Look, I think your observations are well made, and we can get into this in a very subtle way. You have brought in the word quantitative easing. Quantitative easing is exactly similar. A gives to B, B gives to C, C gives to D, D gives to E, E gives it back to A. Okay, so everybody's debt is cancelled out, but there is debt. So where is it? It is sitting in the one single person's balance sheet who gave money to A. So that is why, and where is that? That is in Fed's balance sheet right now.
Yes. Thank you so much for that, sir. Let's go back and look at now the gold, silver, copper values. Sridharji, go ahead, sir. 1803, gold was up by $15.
Yeah, gold was up by about $15, but beware that the gold is down. We were about 1900. We covered this in a couple of market summary sections ago where we started the year. The gold is actually pointing to 1750. Gold futures is pointing to 1750. You are not seeing that number here. I'm citing market data the data from the markets. 1750, which clearly shows that recession is here. There is limited supply, and still people are reluctant to participate in the gold economics. So that's another indicator. 1, inflation. 2, economic contraction. 3, inverted yield curve. 4 is the slipping commodity rates, notably gold, silver, and copper, is an indication the markets are in for very tough time.
Yes, sir. And now let's take a look at, before we go to GDP, there is one topic that I want to touch upon. Both Goldman Sachs and Morgan Stanley have expressed concern at all the banks and other sectors losing jobs. And they are wondering where we are headed. One thing. Second thing is the illegals are still continuing to come in, and they are being put up in hotels. In fact, there is a fear that this particular policy that is not only being done by US, but also being done by United Kingdom could cost Rishi Sunak his job. The British are mad right now, sir.
Well, first and foremost, to answer your question, I think in the last last section, Thursday, I think somebody raised the question, what's happening to the tech sector? Tech sector is under rampage. Lots and lots of people are being laid off in the tech sector. And from Indian audiences, those who have interest in the tech sector, the H-1B visa holders are running from here to there to everywhere because they have a limited window of time before they find another sponsor so they can transition their H-1B visa. Otherwise, they all have to leave or they have to stay on like the illegals. It has a consequence to their wives, their children, etc., who are now mainstream participants in the ecosystem. So tech is continuing to go through a significant rampage in terms of the employment. Driven by economics as well as productivity. Now, that has not spared the banking sector, and you will soon see this spilling into manufacturing sector. the banking sector is laying off because with economic contraction, market participation and market activity is going to contract. Goldman Sachs is laying off close to 8% of the people. We covered this. Morgan Stanley has laid off a significant number of people, and more banks will follow suit. That simply says that there is no demand. So clearly, Jerome Powell's wishes or boon is being fulfilled by some of these tech people as well as the banking sector. But that is counterbalanced by two things. One, you have a significant number of illegals coming in, and they're getting into some of the jobs, okay? Because many states have said illegals can be given jobs, they can apply for healthcare, they will also be given settlement allowances by
I seem to have momentarily lost 𝙤𝙬𝙤𝙬, and I'm sure he will rejoin in just a moment. 𝙤𝙬𝙤𝙬, are you back?
I'm back. Can you hear me?
Yes, sir. Please continue, sir.
So I think that Jerome Powell is how he's going to wrestle with this issue, because the next border surge is almost imminent and more people are coming in and they all occupy the casual jobs and they'll get listed as jobs. So this is going to be the balance. And this whole theory that you are going to look at the labor index, labor market index as a parameter for doing economic management, in my view, is the policy framework that Dr. Powell is looking at, and it is going to hurt. It is going to hurt because supply side continues to happen on the employment side. You pointed out UK. When UK has got several problems, just leave alone employment. And to answer your question, one of the things that they left Brexit was Brexit allowed refugees to come into EU, and the Britain didn't want to take it. That's one of the big parameters besides the economic. And if 𝙤𝙤𝙤𝙬 says that he's going to bring more people, he's in trouble, Sriji.
No, he has made that his platform that he is going to crack down on illegal immigration, but we are talking about those who have already arrived there. Britain has some of the most liberal policies. It doesn't matter your status, whether you are illegal or legal. The moment you are accepted on British soil, you get a bunch of benefits. This is what people are aiming for. They don't stop at Europe. They keep coming and coming and coming, and they want to make Britain their home. This is something that many people, even high school pass, know that we have to go finally to Britain. That has been the case for many years. Anyway, sir, let's take a look at GDPs of various country projections, and this is going to be the framework for our discussion moving forward, and then we'll take the questions. Go ahead, sir.
So, okay, so United States, as you can see, we're going to finish in 2022 at about 1.6, 1.5% or 1.8%. Now, the projections are we are going to contract to 0.1% in 2023. That's the forecast. And 2024, we are only in expecting a modest tick about 1 point. So we are in recession as far as 2023 is concerned. Next, you can look at the Eurozone. Eurozone had a slightly better economic outcome, 3 point, mostly driven by the first Q1 and Q2 data, and Q3 onwards, the depression kind of set into the European market. Almost all across the major Western European nations, you saw the suffering ranging from Germany to France to Italy to Spain to UK. But what is more ominous is when you look at the 2023 forecast, except Sweden, except Spain, most of the other nations are contracting, and the contraction is just over 0%, but it's shown as 0.0%. So the economic outlook, even when you look at 24 and 25, is a very modest increase. So that's a sign Eurozone is in deeper trouble, much deeper trouble than, let us say, United States. So if you are reliant as a trading partner with US and Euro in terms of enhancing your economic activity, you are even in deeper trouble by virtue of significant contractions in the US and Eurozones. Driven by what? Driven by inflation. Everybody has got energy crisis. That's the top line. Number two, driven by supply chain. So there's a top line on the food. Driven by people want to travel. One of the highest inflationary points is airline travel. So you have that. So then you have commodity prices have come down, but it has still not cascaded itself by virtue of the supply chain issues. So which is why you are saying the the eurozone, negative impact in eurozone. Coming to Asia, Asia zone is the only hope in for the foreseeable future. I think that we will expect about 3.2% in growth, primarily driven by non-Chinese, non-Vietnam, non-Korea, non-Taiwan. These are those who are export economies. They will see significant. But you have other economies, like doing very well in Asia. So Asia will be the kind of what you call the green shoots or the hope. And then, of course, you look at India. India will do quite well. We have talked about it. India's economy is expected to grow somewhere around 6% in 2020. See, this is calendar, but India estimates its GDP on what they call FY 22-23, FY 23-24, which is this April 1st to March 31st. So I think, in my view, the FY 23 number is around 7%, which everybody kind of agrees. So India will be on a sustained 7% or somewhere close to 7% economic trajectory. So it is the most well-performing economy. So the people, again, I can only answer at the macro level as a markets guy. I cannot, or from an economic, I can't answer the question at a micro level in terms of what it means into specific. The reason why the Indian economy has done well is actually 4 factors. One is it is a strong domestic economy and less reliant on external forces and external factors, number one. Number two, many countries which have significant trade flows. See, India is not even a 1 trillion export economy. It's around $500 billion or $400 billion export economy. So there is less impact as a result of the global trade flows that creeps into the Indian economy. So that's the second factor. I think the third factor is that there has been tremendous amount of infusion of foreign direct investment and capital into India, which we have covered. So much of the debt has been augmented or substituted by the FDIs. If I have to use a rule of thumb number, at 2013, 2014, India was around $25 to $26 billion or $29 billion FDI. Today, it is around $90 billion FDI flowing into the Indian economy on an annualized basis. And finally, the other factor is that India is the 4th or 5th largest by virtue of the FX reserves it holds. So there's a significant cushion if there is pressure on importing issues. So therefore, once upon a time it was 650. It's right now around 560, 570 billion. That is sufficient. So India has managed using this, what I call as the macro fundamentals in terms of stabilizing and managing its economy and much of the manufacturing. We will cover this in much more detail, but you can see for the first time manufacturing is substituting the growth, particularly in the services sector, which means manufacturing is coming back into India through all these PLI programs. So I think this is the difference between India and India today relative to what it was. So it has got a structural kind of reforms. It has also got a monetary policy framework, what they call as the MPC, Monetary Policy Committee. So its rates is not arbitrary and imposed. So there is a team that is looking at this and providing input to the RBI. So this is my kind of observation on the India on the macro side. Similarly, we will cover, we don't have time, Latin America as well as Africa. Africa is also going to be a very, very big ray of green hope, which is the reason why Japan, United States, China, India, all focusing. They have demographic dividends. 1.2 billion people or 1.1 billion people in Africa. The economy size is 3 trillion, almost the size of India. Hence, it's a very attractive, notwithstanding the chaos that is prevalent across those 35 countries.
Thank you very much, Sridharji. And now let's take a few questions. Sridharji, I request you to keep the answers to 1 minute or less, sir, so that we can, 5 or 6 questions are there. So this one we have covered. Can we go to the next one? Yeah. Sir, Dhiran Vinod wants to know, would the moves by the Fed increase handouts, also known as socialism, in the population?
Answer is yes. We already 50% of the population believe in socialism.
Sir, this is this is the fiscal policy of the Biden administration, sir. Dictator 12321. Come on, you should put your name. We are not going to report you to anyone, and they don't have time to look at us anyway. This time they are also playing with repo rate. Sir, your thoughts?
Well, I think the central bankers, whichever way we want to calibrate, they act according to the markets. According to the data, whether I don't know, Sriji is an expert whether one note is printed 6 times or one note is printed 3 times. When you look at the rates, when you look at the inflation has come down to below 6%, and last year around November it was annualized around 4.12. We covered this. So naturally, when you see the market data, they would need to look at the rates, and they continue to increase in this 35 basis point hikes, in tune with not to have asymmetric with the Fed rate, which is effectively the global basic rate index. So they are doing it only to make sure that there is a rate equilibrium, but there is nothing to indicate that they need to sustain, only to prevent any kind of headwind inflation, these rates go up. But structurally, I think it is correlated to the economic numbers as well as the inflation. And there's an independent committee, however independent you may want to call it.
𝙒𝙗𝙤𝙪𝙥𝙤 wants to know, why are US 10-year yield decreasing whereas Indian 10-year yield is increasing?
India is always on relative to the rest of the markets. India is always on a higher rate curve. Remember, whenever there is significant growth, you don't want to have inflation creeping in. India is on a high yield growth rate trajectory, so they want it to be a proper growth, but not an inflation driven growth, and hence the rates are always rising. United States growth rate, as you can see, is sub 2%. India may not have a recession, but clearly US will have a recession. So US is not facing the same contagion. India is not facing the same contagion as US. India wants to avoid the contagion, so the long-term rates will always be a little higher in a rising economy.
Darshan S wants to know, why the same dollar depreciation effect not seen in USD INR in the recent past month move? I think what he's trying to say is, as the US dollar is falling, the Indian rupee should be rising because the US dollar is falling. When the US dollar rises, the Indian rupee falls. The reverse doesn't seem to happen. That's his question.
The question is that US is Indian rates. You need to look at Indian rates are already indexed to the US rates and the interest rate.
It's a basket of currencies. Yeah.
It's linked. India is significantly exposed to the US. So, the rate was fixed around 2%. Today, the US rate is around 5.2%. So this is why the Indian finance minister says, hey, look, relative to the world, is not anything wrong with the Indian economy, but it is to do with what's happening in the US. So when you have a high-cost dollar, that naturally has to feed into the currency markets, which is why you are seeing this. The increases that we are talking about in euro and British pound is very marginal in what we call basis points. Once upon a time, euro was 1.15, 1.2. Today, it is 1.05. It's not relatively on the same basis for the Indian rupee.
Next question, please. Dictator 12321 again. Due to higher debt/GDP, Russell Napier had predicted higher duration of high interest rates.
What is the question?
I think higher. Why does the Fed want to keep their interest rates higher for a longer time?
Let me tell you, I don't know about Russell. I know Russell Napier, but the story is, I don't believe the interest. I think the interest rate of 5%, 4.25%, and maybe one increase next year is what they should have done. And they should have addressed the fiscal side, and they should have addressed the supply side, but they're going about the wrong way by raising rates and focusing on the labor policy, on the labor index. So I don't agree with Dr. Powell's, but she said, please put on the shoes of Jerome Powell and answer the question. So I tried to give the answer as to why he is looking at that way, but I don't agree with the approach that he has taken.
Okay. Vishwas Indraganti, is Fed going to pivot soon? Vishwas, I think we answered this question. If you want to add a couple more lines to that, sir. They're not going to pivot soon, right? All of 2023, they're not going to do it.
No, 2023 is ruled out. Originally, it was 2023 because they said that they will de-accelerate the rate of increase. But now they are saying they will maintain sustained rates, and they don't see rates coming down anytime soon in 2023. So it looks like more 2024. Yeah.
Next question from CA Viswanathan V. Can RBI increases repo rate further? Your view on 𝙦 prediction of long-drawn recession?
What is 𝙦 prediction of long-drawn? Sorry, Shriji, clarify.
No worries. Vishwanathan, you need to send us a link of this one. We'll try to touch base on this one in our next program. So go ahead and put it in the comment section. We need to understand what 𝙦's prediction is. We don't know that. And there's a thank you from Sridharji. There are a lot of people thanking you, sir. Very, very, very informative discussion. Here is, his name is Vineet, Dictator 12321. Here is another one, Vishwas Indraganti. Thank you, Sridharji. Sir, this format is nice, and I think people need to get a little bit more into depth if you want to take some data and understand and pass the numbers. We are not reading tea leaves here; we're reading data, and we're telling you what we see. And Sridharji, do you think this illegal immigration thing is going to stop, sir? Because I'll tell you what, we are done with the program. I just want one parting thought here, sir. You put them all in big hotels, right? Now the pressure is building. If the hotels are busy servicing them, then where is a businessman going to go and stay, sir?
Businessmen will stay in if you come to our tri-state area, New Jersey, New York, Connecticut, we have this parking lots. We park our cars and parking vans, and then many of the people who are in those places take bus to their work. So these parking lots with temporary homes in the cars can be used. That's one way. Shriji, you come from a very, very liberal and generous state of California. If you have additional bedrooms, then through what they call, I forget the name of that thing, you can rent out to the businessmen.
Airbnb.
Yes, Airbnb. So that's why Airbnb came up. Jokes aside, no, it's not coming down anytime soon. The worst thing is the Title 42 that Trump had imposed. Title 42 is going to be now repealed. This is why there is going to have a surge. It's going to be repealed. That means if we can't find something justifying you stay in Mexico till we get the thing. No, Title 42 is repealed. So welcome home, boys. And we welcome you with open arms. So more and more and more people are coming in, Shriji.
Well, sobering thought. Thank you so much, Sridharji. And viewers, please like, share, and subscribe to our channel. Don't forget to click on the bell button for notifications. And a clarification, if you want to ask questions and donate during the live session, you have to do it using Super Chat. The super thanks button comes only after the program goes live and is already on YouTube. While it is going live, you have to use Super Chat button. Thank you once again, Sridharji. Hope this clarification helps. There were some people asking us during the previous program. I didn't do the research at that time, didn't have the time, but now I have done that. So thank you so much, sir. Namaskar.
Thank you. Namaskar. Have a wonderful weekend. And today is the football finals day. So whether you are Argentina supporter or whether you are the French supporter, good luck to your teams and best wishes. So I think I expect it to be a great game today.
Thank you, sir.